Hey guys, welcome back to my channel. My name is Juan, and if you're new here, bienvenido. Inflation continues to rise. That's a theme that we've heard a lot lately in the news. The Fed admits inflation is higher than they expect, but they think it's going to return to normal next year. In other words, like the Guns N' Roses song says, all we need is a little patience. Now, I don't know if the Fed is going to be right or wrong about this, but the question is, what can we do in an inflationary period? And in this video, I go over 3 ways to invest against inflation. So this topic came to me because I saw an interview with Jeremy Siegel recently. He's a famous finance professor at Wharton School, and he said in the interview, and I quote here, "Inflation in general is going to be a much bigger problem than the Fed believes." He's generally very positive, so this was surprising to me. But he does seem really concerned about, inflation going forward. And I think his concerns are with good reason. So the first thing is, look at this. Consumer prices in the US were up 5.3% annually in August. That's the highest in 13 years. And this has been the trend over the past several months, right? In addition, Professor Siegel projects a 5 to 7% annual inflation over the next few years. This is much higher than the Fed's long-term target rate of 2%. What does that mean? For us investors, is that we need to invest our money and it has to return about 5 to 7% annually just to keep up with inflation. That's a lot. I mean, think about it nowadays. If you go to a bank and you try to get a CD or a savings account, you're not going to get more than 0.5%, 0.6% maybe. So 5 to 7%, that's a tough one. On top of that, inflation is not only running high in the US, but also around the world. Look here, across the pond in Europe. Inflation is highest since 2008. Right? If we look at Germany, which is the biggest economy in Europe, a 29-year high. In the UK, a 9-year high. Right? If we move into Asia and look at China, which is the biggest economy in the region, same thing, right? Inflation is running high. Now, in China and the UK, the other problem is that energy prices are also soaring, which, all that is just going to filter through to the products that they and we consume. I'm not trying to scare you or be negative. Instead, as an investor, I'm trying to lay out what's happening and what to do in an inflationary period. Now, going back to what Professor Siegel was saying in the interview, is that he likes stocks that will benefit from rising interest rates, have pricing power, and deliver dividends, right? So what is he suggesting? The first thing that he suggests is that, he likes utility and consumer staple companies. Yeah, I know, boring companies, right? However, these boring companies have the characteristics that do well with inflation, right? Just think about, pricing power, right? If a company has a product that we as consumers, are going to still purchase it regardless of what's happening in the economy, that's pricing power, right? In a utility company, for example, right? We're not going to stop paying our utility bill just because prices are higher, right? Same thing with, toilet paper or laundry detergent. We're still going to purchase those products from Procter & Gamble, right? On the other side, and this one's interesting, we're probably going to stop buying or buy less venti frappuccinos or venti lattes from Starbucks, right? If the prices rise for a company like Starbucks, they're going to have a harder time passing it along to us, right? And I like Starbucks. I don't have anything against that company, but their margins will be impacted if commodity and labor costs rise with inflation. Now, the other part is the dividends. Professor Siegel said, and I'm quoting here, historically, dividends are inflation protected. So, like consumer staple companies and utilities, they pay good dividends. But I would also add energy companies, right? For example, and think about those companies, why I like them as well. If a home has, natural gas for cooking and heating, we're going to use that product and we're going to pay for it, regardless of what's, happening in the economy. And typically those energy companies also pay really good dividends. Now here's a list of ETFs that cover what Professor Siegel was talking about, the type of companies that protect you against inflation. Also, by the way, I'm going to include a link here to my previous video on ETFs, because one of the ETFs included in this list here is the Schwab Dividend ETF, which I talked about more in depth in my ETF video that I will link to this link down below. Now, in terms of other assets that Professor Siegel likes, is that he said he was bullish on gold and real estate. Now, calling gold bullish in this day and age of Bitcoin and meme stocks, it's a little bit old-fashioned, right? But he has a couple good points. So the first one is that he said that in the 70s, when we saw high and persistent inflation, everyone turned to gold, right? And other commodities as well. That's the first point. Now, the second one was that he thinks gold has been overlooked because of the popularity of Bitcoin, which makes, gold a less overbought and a less risky alternative against inflation. The other point that comes to mind for me is that when the Fed tapers, usually some investors move from growth assets, like Bitcoin in this case, and into underlooked and historically, inflation protection assets like gold. Now, this makes sense to me, but I am not fully convinced that gold is a better alternative than Bitcoin. But I do think commodities like crude oil or natural gas have better potential than gold. With that said, I did wanted to share a couple of gold ETFs that I think are interesting for you to look at. The last piece of advice that Professor Siegel gave is that he likes real estate to protect against inflation, right? Now, he doesn't think real estate is in a bubble. I tend to disagree with that. And I'll tell you why. US home prices are up 16.2% in August. And that's year over year, right? That's a big increase for real estate in 1 year, which has been driven by low rates, which if the Fed starts tapering, that's going to change. Low inventory, which is a problem, and the stimulus the economy has gotten over the past year, right? So all these factors contribute, in my opinion, to there being some type of bubble, right? However, I feel though, the key to real estate holding steady is going to be how high mortgage rates go, right? This will be determined by how the Fed tapers in order to control inflation. If rates go higher than they expect, then demand for housing will decline and housing prices will decline as well. This is probably not a short-term scenario, but probably a little bit more longer-term scenario, right? And then again, that's just my opinion, but I wanted to provide that to you as well. So that's all I have for you guys today. Thank you for joining. If you found the content of this video valuable, please give it a thumbs up, right? And subscribe. Let me know what you think also in the comments down below. And I will see you in the next one. Adios.